car market is collapsing, and it's happening faster than anyone expected. Across the country, dealerships are drowning in unsold cars. Trucks and SUVs are sitting on lots for over 220 days. Repossession rates are skyrocketing, and for the first time in years, automakers are slashing prices by as much as $20,000, desperate to move inventory before the crash gets even worse. But here's the real question. Why is this happening, and what does it mean for you? Is this the best time to buy, or a sign of something far more dangerous? What's happening? Right now, car dealerships across the country are offering some of the biggest discounts in years. Some vehicles are being marked down by as much as $20,000, and it is not just limited to slow-selling models. Popular trucks, SUVs, and even electric vehicles are seeing unprecedented price cuts. Dealers are offering zero-interest financing, massive cashback incentives, and lease deals that seem too good to be true. If you are looking to buy a car, this might seem like the perfect time to strike a deal, but is it really? The reality is that these massive discounts are not happening because dealerships are feeling generous. They are a sign of desperation. Automakers and dealerships are sitting on a mountain of unsold inventory, and they are struggling to move it. With interest rates at their highest levels in decades and inflation pushing household budgets to the limit, fewer people are buying cars. As a result, dealers have no choice but to cut prices just to make sales. But there is a hidden risk here. While these discounts may seem appealing, the vehicles losing value so quickly could spell disaster for buyers. A car you buy today at a deep discount could lose thousands in value in just a few months, trapping you in a negative equity nightmare. Even worse, if dealerships are this desperate now, what happens next? The truth is, these discounts are not just good deals. They are a warning sign of a much bigger collapse. The car market is drowning in unsold inventory. The biggest reason for these insane discounts is simple. The auto market is drowning in cars that no one is buying. Right now, there are over 2,800,000 new cars sitting unsold on dealership lots across the country. That is one of the highest inventory levels in recent history, and it is only getting worse. Some of the hardest hit brands include Ram, Nissan, and Ford, whose trucks and SUVs are sitting for more than 220 days without a buyer. This is unheard of. In a normal market, dealerships expect to move inventory in a matter of weeks. Now they are stuck with months-old stock, and they cannot afford to keep piling up cars. So how did this happen? It is a combination of several miscalculations. First, automakers ramped up production, assuming that demand would remain high after the pandemic supply shortages. But once interest rates skyrocketed, buyers pulled back, and suddenly there were way too many cars and not enough buyers. On top of that, automakers bet big on expensive electric vehicles just as consumers started turning away from them due to price and charging concerns. Now, the industry is caught in a vicious cycle. Dealerships cannot sell enough cars, manufacturers keep pumping them out, and as the inventory piles up, prices drop even further. But the worst part? Even buyers who got a deal last year are now in trouble. It is not just that cars are sitting unsold. The people who did buy cars in the last few years are now facing a financial disaster. The repossession crisis. Buying a car used to be an investment that held its value reasonably well, but today, the auto market is creating a financial trap for millions of Americans. The average new car payment has now surged past $760 per month, making it one of the highest household expenses for many people. Some buyers, especially those who purchased during the post-pandemic car shortage, took on massive loans with high interest rates, expecting their cars to hold their value. But as dealerships slash prices on new models, used car values are plummeting, and many borrowers are now upside down on their loans. Right now, 1 in 5 car owners owes $10,000 or more than their vehicle is worth. This means that if they needed to sell their car or trade it in, they would still owe thousands to their lender. And as more people struggle to make payments, auto repossessions are skyrocketing. In the past year alone, auto repossessions have surged by 23%. More and more people are losing their cars simply because they cannot keep up with their payments. But here is the real problem. When lenders repossess cars, they sell them at auction for far less than their original value, driving used car prices down even further. This creates a dangerous domino effect. As more cars get repossessed and flood the market, resale values drop even more, trapping even more buyers in negative equity. And for car manufacturers, this means even fewer people willing or able to buy new cars, further deepening the industry's crisis. But this crisis is not just hurting individual car buyers, it is now spreading through the entire economy. How this collapse could trigger a recession. Ford, General Motors, and Stellantis are all experiencing stock declines, and even Tesla's once booming EV market is struggling. Consumers cannot afford high monthly payments, and banks are tightening lending standards, making it harder for people to get approved for car loans. The biggest concern? This could be the tipping point for a broader economic downturn. A significant drop in auto sales has historically been one of the key indicators of a coming recession. When people stop buying cars, it is often because their finances are stretched too thin, and that spells trouble for other industries as well. If this trend continues, we could see more layoffs in auto manufacturing and related industries as companies scale back production in response to declining demand. Next, there could be a slowdown in consumer spending as people cut back on big-ticket purchases like cars, home improvements, and travel due to financial uncertainty. Finally, the financial sector could take a hit as banks and lenders become more cautious about approving auto loans, leading to even tighter credit and higher borrowing costs for everyone. Right now, the signs are eerily similar to what we saw before the 2008 financial crisis, when risky auto loans and declining car values contributed to the recession. If car sales continue to slide and repossessions keep climbing, the next phase of the crisis could be even more devastating. But what is really behind this collapse? It is not just bad luck, it is the direct result of Trump's economic failures. Trump's tariffs, how they drove car prices up. During his previous presidency, Trump waged a trade war with China, Mexico, and Canada, imposing billions of dollars in tariffs on imported auto parts and raw materials like aluminum and steel. While these tariffs were meant to protect American manufacturing, they backfired spectacularly. Instead of revitalizing the US auto industry, they forced automakers to pay higher prices for materials, which they then passed on to consumers in the form of more expensive cars. Fast forward to today, and the effects of these tariffs are still being felt. With manufacturing costs at an all-time high, automakers have hiked up their vehicle prices, making new cars increasingly unaffordable for the average buyer. At the same time, rising production costs forced manufacturers to cut back on discounts and incentives, making it harder for dealers to sell cars even when demand was high. The result has been catastrophic. Car prices have skyrocketed, and now, as demand crashes, manufacturers are stuck with overpriced inventory they cannot sell. Even worse, Trump has promised to reinstate and expand these tariffs in his current term. If he follows through, auto prices will go up even further, worsening the crisis instead of fixing it. But tariffs were just the beginning. Trump's reckless tax cuts and economic policies also set the stage for today's financial instability. The tax cut disaster, why the middle class is struggling. When Trump slashed corporate taxes in 2017, his administration promised it would lead to massive economic growth and higher wages. Instead, the benefits overwhelmingly went to the wealthy and large corporations, while the middle class got left behind. Rather than investing in workers or lowering prices, automakers used their tax breaks for stock buybacks and executive bonuses. Meanwhile, the average American saw little to no increase in income, even as the cost of living surged. Now, as car prices remain at record highs, middle-class Americans cannot afford to buy new vehicles without taking on crippling debt. But with interest rates rising and wages failing to keep up, many buyers are finding themselves trapped in financial hardship. This is a direct result of Trump's failed trickle-down economic policies, which did nothing to strengthen the financial stability of the average American. Instead of creating an economy where people could comfortably afford major purchases like cars, his tax cuts exacerbated income inequality, leading to the affordability crisis we see today. But it is not just that people cannot afford new cars. Trump's deregulation policies also made car loans more dangerous. The auto loan crisis. One of the biggest financial risks in the current auto market collapse is the explosion of predatory car loans. Under Trump, financial regulations on auto lending were weakened, allowing banks and dealerships to offer riskier loans with longer repayment terms, higher interest rates, and lower credit requirements. During his administration, Trump's policies rolled back consumer protections, which allowed lenders to push more Americans into expensive car loans they could not realistically afford. The average car loan term ballooned from 5 years to 7 or even 8 years, leaving many buyers trapped in long-term debt for vehicles that depreciate faster than they can pay them off. Now, with record-high interest rates, these risky loans are becoming unmanageable for millions of Americans. Auto loan defaults are surging as more people are missing payments, leading to a rise in repossessions. Negative equity is at an all-time high, with borrowers owing far more on their cars than their vehicles are worth. Banks are tightening credit as so many loan defaults have made lenders more selective, making it harder for consumers to get approved for car financing. This is exactly what happened in the 2008 financial crisis, when deregulation led to a housing market collapse. Now, we are seeing the same warning signs in the auto industry, but as bad as the loan crisis is, it is not the only way Trump has made things worse. His policies are also hurting the auto industry itself. Trump's attack on the auto industry. One of his most damaging decisions was rolling back fuel efficiency standards, which forced automakers to rework their vehicle lineups and make expensive last-minute changes to meet new regulations under the Biden administration. Instead of giving automakers stability and time to plan, Trump's constant policy shifts created uncertainty, making it harder for manufacturers to make smart investments. At the same time, Trump's hostile approach to electric vehicles has put American automakers at a disadvantage. While other countries have invested heavily in EV infrastructure and incentives, Trump has repeatedly dismissed EV technology, making it harder for companies like Ford, General Motors, and Stellantis to compete in the global market. As a result, Tesla is losing market share to Chinese EV manufacturers, as brands like BYD continue to dominate the EV industry while US automakers struggle. Automakers are canceling EV projects as well. Companies like Ford and General Motors have had to scale back their EV plans, leading to massive losses. Meanwhile, car companies are cutting jobs as demand for gas-powered vehicles declines and EV sales fail to meet expectations. With so many layoffs across the auto industry, thousands of American workers are now facing economic hardship. Trump's inconsistent policies have made it harder for automakers to adapt, leaving them vulnerable to the current market collapse. With the auto industry in crisis, the question now is, can the market recover, or is this just the beginning of a larger collapse? The market collapse. How bad will it get? The auto market is in free fall, and all signs point to even bigger problems ahead. Over 2,800,000 new vehicles are sitting unsold on dealership lots across the United States. Some models, like the Ram 1500 and Ford F-Series, have been sitting for over 220 days with no buyers in sight. Inventory levels are at an 8-year high, and automakers are slashing prices in a desperate attempt to move cars. Despite these discounts, demand continues to fall. Rising interest rates, inflation, and record-high vehicle prices have priced millions of Americans out of the market. Many potential buyers simply cannot afford a new car, especially with the average monthly car payment now exceeding $760. Loan defaults are soaring, and repossessions have jumped by 23% in the past year. Dealerships are struggling to survive as unsold inventory continues to pile up. Many are being forced to cut their losses, offering deep discounts just to avoid bankruptcy. But even with these price cuts, many buyers remain hesitant, fearing further price drops that could leave them stuck in negative equity. If the current trends continue, the market could collapse even further. Automakers may be forced to shut down factories, lay off workers, and cut production to prevent a total meltdown. This would send shockwaves through the economy, further deepening the crisis. But what does this mean for car buyers? Should you buy now or wait for prices to drop even further? Should you buy a car right now? With car prices finally dropping, many buyers are wondering if now is the right time to make a purchase. On one hand, dealerships are offering some of the best deals in years. Zero interest financing, cashback offers, and discounts as high as $20,000 on certain models. If you have been waiting to buy a car, this could be your chance to get a deal that was unheard of just a few years ago. However, there are serious risks to consider. The market is still in free fall, and prices could drop even further in the coming months. If you buy now, you could find yourself stuck in a car loan for a vehicle that is worth significantly less than what you paid. Negative equity is already a major issue, with 1 in 5 borrowers owing $10,000 more than their car is worth. Additionally, interest rates remain high. The average auto loan interest rate is 7.2% for new cars and 11.4% for used vehicles. If you finance a car at these rates, you could end up paying thousands of dollars more in interest over the life of the loan. For those considering a purchase, the best strategy may be to wait a little longer. As inventory levels continue to rise and automakers struggle to move cars, prices may drop even further. The key is to be patient and watch the market closely. But what about automakers? How are they responding to this crisis, and what does it mean for the future of the industry? Automakers' response: can they survive the crisis? With the auto market in chaos, major automakers are scrambling to adapt. Some are slashing production, while others are shifting their focus to more affordable models. Ford and General Motors have already announced plans to cut back on their electric vehicle investments, as demand for EVs has failed to meet expectations. Instead, they are doubling down on hybrid and fuel-efficient gas-powered cars, hoping to appeal to cost-conscious buyers. Meanwhile, Stellantis is facing a full-blown crisis. With unsold inventory piling up, the company has been forced to lay off thousands of workers and shut down production at multiple plants. Nissan, which has seen a 70% drop in anticipated profits, has also announced plans to cut 9,000 jobs worldwide. Even Tesla, which has long been the leader in electric vehicles, is feeling the impact. With increased competition from Chinese EV makers like BYD, Tesla has been forced to cut prices on multiple models. This has led to declining profit margins and concerns about the company's long-term viability. Despite these challenges, some automakers remain optimistic. They believe that once inflation stabilizes and interest rates come down, demand will rebound. However, if the economic downturn continues, more layoffs and factory closures could be on the horizon. But even if automakers manage to survive, what does this crisis mean for the broader economy? Could it trigger a full-scale recession? Could this crisis lead to a recession? The auto industry has long been a key driver of the US economy, and its collapse could have far-reaching consequences. When car sales drop, it affects not just automakers, but also suppliers, dealerships, and thousands of businesses that rely on the industry. Already, major automakers have seen their stock prices plummet. Ford, General Motors, and Stellantis have all taken massive hits in recent months. Even Tesla, once considered untouchable, has lost significant market value. The impact is also being felt in the financial sector. Banks and credit unions, which have issued billions of dollars in auto loans, are now facing increased risk as defaults rise. If repossessions continue to climb, financial institutions could be forced to tighten lending standards, making it even harder for consumers to get approved for car loans. Beyond the auto industry, the broader economy is showing signs of strain. Rising inflation, high interest rates, and declining consumer spending are all contributing to economic uncertainty. If the auto market continues to crash, it could push the US into a full-blown recession. Some analysts believe that the government may step in with financial aid to prevent a total collapse. However, with growing political divisions and concerns about government spending, it is unclear whether such a bailout would even be possible. With so much uncertainty, the question remains: what will happen next, and is there any hope for recovery? The government's role: will there be a bailout? With the auto industry in crisis, many are wondering if the government will step in to prevent a total collapse. In the past, automakers like General Motors and Chrysler received massive bailouts during the financial crisis of 2008. These government interventions saved millions of jobs and prevented the total collapse of the US auto industry. But this time, things are different. The political climate has changed, and there is far more resistance to large-scale corporate bailouts. Many lawmakers argue that automakers have made their own mistakes, overproducing cars, failing to adapt to changing consumer demands, and relying too heavily on unsustainable pricing models. Others believe that a bailout would only delay the inevitable, as companies like Stellantis, Nissan, and Ford are already in deep financial trouble. If the government does step in, it will likely come with strict conditions. Automakers may be forced to restructure, close underperforming factories, and shift their strategies to focus on more affordable and fuel-efficient vehicles. However, without immediate intervention, many companies may be unable to survive the coming months. But even if the government does not bail out automakers, could a merger or acquisition save struggling companies? The merger question. As financial pressure mounts, the idea of mergers and acquisitions is gaining traction. Some analysts predict that struggling automakers may be forced to combine resources in order to survive. One major possibility is a merger between Nissan and Honda, which has already been rumored in industry circles. Nissan is facing record financial losses and job cuts, while Honda has been struggling with declining sales in key markets. A merger could allow both companies to streamline operations, reduce costs, and develop more competitive models. Another potential scenario involves Stellantis, which oversees 14 different brands, including Jeep, Dodge, Ram, and Chrysler. With sales plummeting across multiple divisions, Stellantis may be forced to sell off some of its brands. Companies like Volkswagen or Toyota could step in and acquire struggling brands, preventing them from going under entirely. However, mergers are not always the perfect solution. Combining two struggling companies does not necessarily create a stronger business. Without the right leadership and strategy, a merger could just prolong the inevitable collapse. But if automakers truly want to survive, they will need more than a bailout or a merger. They need a complete shift in strategy. Can automakers fix their mistakes? If automakers want to survive, they need to make major changes and they need to do it fast. The old way of doing business, overproducing expensive vehicles and relying on high-interest loans, is no longer sustainable. First, automakers must stop overproducing cars that people cannot afford. Inventory levels are at record highs, and companies like Stellantis, Ford, and Nissan are sitting on millions of unsold vehicles. Instead of flooding the market, manufacturers need to scale back production and focus on producing models that actually meet consumer demand. Second, companies must rethink their approach to electric vehicles. While the industry has pushed hard for electrification, consumer interest has not kept pace. Many buyers still prefer gas-powered or hybrid vehicles, which offer more affordability and convenience. Automakers should adjust their EV strategy to focus on more practical, cost-effective solutions rather than forcing high-priced EVs onto the market. Finally, automakers must make pricing adjustments. Car prices have skyrocketed in recent years, far beyond what many consumers can afford. Offering more competitive pricing, better financing options, and stronger trade-in incentives could help bring buyers back into the market. Without these changes, the auto industry may continue to spiral downward, and more companies could face bankruptcy in the near future. But even if automakers manage to recover, what does the future of the car market look like? The future of the auto industry. What happens next? The car market will never be the same. Even if the industry recovers, the economic and consumer trends shaping the market today will have lasting consequences. One major shift is the increasing importance of affordability. The days of automakers prioritizing luxury features and sky-high price tags may be coming to an end. As consumers demand more practical and budget-friendly options, manufacturers will have to adapt or risk losing their customer base. Another change is the evolving role of electric vehicles. While EV adoption has been slower than expected, it is still inevitable in the long run. However, automakers will need to strike a better balance between offering EVs and continuing to support traditional gas and hybrid models for those who are not ready to make the switch. Finally, economic uncertainty will continue to shape the industry. Interest rates, inflation, and global trade policies will all play a role in determining how the market moves forward. If the economy stabilizes, demand could slowly return, but if financial pressures continue to mount, we may see even more drastic shifts in the industry. Regardless of what happens, one thing is clear: the car market is in the middle of a massive transformation. The companies that adapt will survive, while those that fail to change could disappear entirely. The auto market is in crisis and the future is uncertain. Do you think the industry will recover, or are we heading for an even bigger collapse? Should the government bail out struggling automakers, or should they be left to fix their own mistakes? Let us know your thoughts in the comments below. Also, if you found this video insightful, make sure to like and subscribe for more updates on the car market, the economy, and the biggest stories shaping the industry. Thanks for watching, and we'll see you in the next one.